I'm Scott Forcino from eXp Realty, New York City metro area, which includes the suburbs. I founded PlugIntro so that individuals in the real estate market and the business community can gain more and better referral partners. I have with me an esteemed professional, Jason Ramirez, who is a lender and has a long career. He wants to give us what's up in the market, what's happening with mortgage loan underwriting, and what should buyers expect, and how he works with his referral partners. So good afternoon, Jason. Thanks for coming today.
Good afternoon. Thanks for having me, Scott, and hope you're enjoying the summer.
Yeah, a long summer.
So, there's obviously been some changes this year, with the high inflation, the rise in cost across the board, the rise in rates especially really really put a pause on the housing market. I think it was more of a sticker shock than anything else, simply because they went up so fast, so aggressive that people kind of just they stopped doing what they were doing in terms of looking for a home. And the rise in rates essentially killed the refi market for the most part. I mean, refis are down year over year now, over 70% from this point last year. That's application. Yeah, so that's a real number. But the big one too now is purchase applications. These numbers came out earlier today, 23% down from a year ago today as well. So
wow.
Yeah, so they've taken some real hits to the market, and it's pretty much put the industry on pause for the most part. I think what's going to happen is once people get a hold of this rate and they see that this is kind of going to be the new norm, I think it'll settle out somewhere. Average rates right now will high fours, low fives on the 30-year fix, if that's the gauge you want to use. I think it's going to settle out high fours, low fives, and then I think that's going to kickstart some more activity in the housing market, especially as we go into the spring market.
Well, I was just reading today that a year ago's rates, the rates from a year ago would get you $100,000 more in mortgage money. That's crazy.
Yeah, I mean, look, they were unusually low last year, obviously coming off of it was post-COVID, so it was low, and to be honest, like, rates were just low for a very, very long time. So yeah, I mean, it really did increase a lot of buying power out there, and essentially, really blew the prices of some of these homes out of proportion. I think there'll be a correction, as the market resets, because it's more of a reset. It won't be a crash. I hear people talking crash, but there won't be a crash. It's just going to reset. It'll come down, 5 to 10% in certain areas, depending upon where you are. You might not see anything come down at all if you live in the city, Manhattan. If you were speaking on that, and the some of the metro area, you're probably not going to see any decline at all. I think this is the new market for the most part, especially since prior to that we haven't had much. Once we came out of the housing crisis, there were so many people underwater for so long that they're gaining back some of the appreciation that the market probably should have had.
Right, that's the fake monopoly money. But two things that are true are there is more inventory.
Correct.
And there has been the rate of appreciation has really just stopped. I mean, I said it. We were at the peak, and it's not going higher. So a client of mine was selling in the Bronx recently, and I said, look, it's not going to get better. This is it. You got all the money, all the fake monopoly money you're going to get. You didn't go to work. You didn't work hard. You didn't save money. It just magically went up, and you're benefiting. So, can't get greedy. This wasn't really earnings. This was being in the right place at the right time.
Probably the exact definition of being in the right place at the right time would be, the housing market in, 2020 and 21, so yeah, look, but there was a lot of people that got greedy. They really thought it was just gonna, the real estate market was gonna keep going up forever.
Sure. I had a client also, an older guy who's, we had a love-hate relationship, and I mean in his 80s, and he was complaining about it. I think it was $500,000 on something. And I said, well, what did you buy this house for? He didn't want to tell me. It was like 1979 for 48,000. So, from that day, could you ever imagined $500,000?
I mean, no.
Right.
The appreciation is absurd, but people wanted beyond, they wanted ludicrous is what they wanted,
Mm-hmm.
Spaceball reference, of course. So, they had these crazy ideas that they were going to sell their house for more. And there was so much greed out there, that it really, some of these sales never happened, so, a lot of these people, you're going to start seeing some homeowners, discount their homes somewhat, not a lot, but somewhat. And that's going to be the resetting of the market. That's
sure.
That's going to spurt back, activity in an aggressive manner.
So tell me this, when, you're this researcher and you disseminate this information, how is this conveyed to agents? Do you guys collaborate? I mean, is it a question and answer? Do you volunteer? How does this very, very necessary information get to the hands of the people showing houses? Because you're not showing a house. They are.
Well, I mean, for me, it's all social media, and I have, lots of agents that I'm friends with, and, a lot of them do respond, and I should hope a lot of them, for the most part, I know a lot of them are utilizing the info, so that I know for a fact. But this information is not like a secret. This is pretty. No,
it's not a secret, but this is, I should say, delivered by a professional that can understand the metrics and the indices and, maybe a forecast. The agent, I'm an associate broker. I don't internalize this, and this is the information that should come from someone in the lending industry.
Yeah, like I said, I do. I utilize my social media. I have marketing with Citizens that sends out material on a quarterly basis. So I do try to keep people abreast of what's going on in the market and my my take on direction of the market. I don't really share info in terms of, I don't share other stuff. I just I know what I know. I digest the info and then I kind of put out my thoughts on it. And I try to really simplify it so that it can really be understood. Like I pretend like I'm explaining it to a kindergartner,
Mm-hmm.
just so that they can truly understand it and get it and relay the info. Because a lot of times you just hear, oh, I heard the rate is 7%. I'm like, who told you that?
Right.
Or like, where are you getting that? Or when you quote somebody a rate and it's let's say, for argument's sake, 5.5% for the 30, they're like, oh, somebody told me 4. I'm like, who told you that? So these are people that are just not.
Listen, you have a hard job. Someone calls you. You have no idea if he's got a 560 credit or a 750. I mean, it's these people that they think there's a rate. There's not even a standard price of a gallon of gas. So there's no standard based on the credit, income, and assets. You're talking to two different people. How do they expect accurate information with totally different circumstances?
Well, that's the thing when you're speaking to customers, and when people call you for rate, I often tell them, listen, no two people are created equal, and the finances are different, the situations are different. Single family, multi-unit, certain price points. Is it going to be a Fannie Mae? Is it going to be a portfolio, FHA, investment, second home? It's new. It can be a wide range. So, I do try to profile the person the best I can. I ask them a few key questions, basics. What do you think your credit score is? What type of house? And your estimated purchase point and down payment. And then I'll give you the best rate at that moment. For the most part, but there are too many variables, and I think we discussed this before. There are way too many variables when it comes to interest rate that people need to understand. It's that's why when you're looking online or even reading the paper, if people still do that, and you see interest rates of 30-year fix is 5% or 4.5%. I'm like, what are they basing it on? There's too many variables.
It's like anything else. I mean, there's something going on in the automotive industry where they're trying to ban these low introductory offers, and then the price is way after that. But a friend of mine, and I actually I always think back from over 20 years ago, he's a lender, he's a pretty big guy in Westchester, and he was totally truthful. People say, what's the rate? He goes, what's the rate? Whatever you want it to be. I mean, naturally you got to qualify. I can't, if you qualify, it can be whatever you want. Means you want to pay points. You can buy it down. It's really interesting how he said that. I go, it's whatever you want. I can't be 6'3". I want to, but I can't be. So, you only can get what you really qualify for. So if the guy's eminently qualified and wants a certain rate, he can have it.
100%. I often tell people, interest rates themselves don't change. It's the cost of the rates that change. So you can get whatever rate you want. The question is, are you going to pay an arm and a leg for it? That's the real question, and that's what changes in the markets. That's what the treasury yields change the pricing of these rates. So can somebody still get a 3%? Yeah, but it may cost you 100 G's depending on your housing price point to get it. So in terms of points, discount points. So.
Right.
When people are looking for rates, they're usually looking for a 0-point rate for the most part.
And we're not even always talking about rates. I mean, could you let us know about the non-QM? Because I know the non-QM is taking up a bigger place today. What does that mean? Non-QM? What is QM? What is any of that? How does it pertain to purchasing power?
Okay, so QM versus non-QM. QM, qualified mortgage, is just basically backed, by the Fannie Mae set the standards. They basically set the standards of how they want loans structured. Most banks follow those standards. Okay, they follow their guidelines of how they want the loans underwritten, debt to income ratio, LTV, credit score, etc. So non-QM is basically outside of that. It's portfolio, non-conforming type loans that are not going to be sold to Fannie Mae. They can't be sold to Fannie Mae because they don't fit Fannie Mae's guidelines because they're non-QM. Maybe the credit score was a little too low. Maybe the LTV is a little too high. Maybe they're lending too high, too much to a multi-unit, and so on and so forth. So that's non-QM. That's becoming more prevalent because these banks want to spurt. They want to gain some more momentum, so they're going to start loosening. That's what you're going to see. You're going to start seeing banks start kind of loosening on guidelines.
I saw one when non-QM started, it was like 35%. Now I'm seeing 20%.
Yeah, well, again, it's the same thing that happened right before the housing crisis when they went 100% financing, stated income. All you had to do was say what you made, and the bank believed you and gave you a mortgage. It was
Crazy.
as easy as that. I mean, it will. That is really non-QM. It'll never get to that point again. But these, they're going to have to start, kind of loosening up a little on guidelines, and then you're going to start seeing it, gain more momentum. That's the play. But I think what's happening with a lot of these banks now is that they want to see where the markets kind of level off because there's still a lot of volatility. There's still people touting recession for some odd reason. I don't understand why people are talking recession constantly. It doesn't mean the same anymore. We still have very high rather very low unemployment. So that's been kind of amazing. Inflation's still high. So I think banks want to see where these markets kind of level off and kind of start trending in a certain direction. And I think you'll start seeing them, get a little aggressive with guidelines.
Yeah, that's. I think that's important, and I think agents should always strive to connect with someone like yourself who can give someone a lot of options. Mm-hmm. That this is going to be a new world now, where you think we're shifting into a buyer's market. I'm not sure we are. Just because there's a more inventory, I'm not sure that we are, because those buyers have been always around, but they've been shut out.
Right.
Whether it's FHA or VA, so we're doing things that probably more the way they should do. But I think that relationship, you mentioned that you give this information via social media, and my knock on social media, which people hear me bang, 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 is if I see your posts, on social media. That might be because I follow you, but unfortunately, there's so much good information. I think that someone who, like a purveyor of knowledge like yourself, should strategically target it to those people to make them better. This isn't entertainment. You're giving them some tools and more knowledge that they could do better business.
Mm-hmm.
So, the real point and purpose of PlugIntro is to target and make sure that the people you'd like to know more about this do. And it's a nice relationship when you're offering value like that, and they realize, oh, we're better agents because of the knowledge. I mean, some guy's a pizza place. I never heard of non-QM. Jason, can you talk to him? That kind of thing.
Yeah, I get a lot of, I've worked with a lot of, hedge fund managers over the last, 6-7 years. They've been a bulk of my business, believe it or not. And a lot of them, they ask me for my feedback on certain situations, which I definitely appreciate, and I feel honored, because these are people that are managing, billion-dollar funds, looking for my feedback on interest rates, direction of the market, So, I do give it to them, and there are agents out there that do ask, they ask questions. These are, how is this going to affect, and where do you see rates going? Usually, that's the question. Where do you see rates going? Because I think that's the big selling point for agents, because
I know, but it's really the very, very elementary. It's the very introductory.
It is. A lot of times I just don't think they know the questions to ask. It's like anything else that you only know what you know, right? So where do you see rates going? Oh, rates are in the 4% range, 4.5%. Okay, well this is what you should be able to buy, stuff like that. So, I mean, yeah, you're right. It is elementary, but I think it's a good jump off point too.
There's another conversation that I know people are having. I've done it recently, where taking the properties that all of your time in the real estate market, you've seen price cuts. They have problems because they never. That shows that you were never right. You're also showing the world that you're in a less advantageous negotiating position.
Mm-hmm.
Well, I know some people, myself included, who said, listen, instead of going from 550 to 525, that's nothing. People expect that. That's a drop in the bucket. No one thinks they just think it was overpriced to begin with, and it's indicative of a bad job. What I have done recently is taken that 25,000 and offer to buy down buyers' points or assisting closing costs. Now you have the most attractive game in town, because the other houses on the market are not giving you anything towards your mortgage or towards your closing costs, which are everything involved, your taxes, your title bill. So that's something that, utilizing your position as a mortgage professional, that's something that agents should be talking about, because now we're really connecting mortgages with sellers, which is unheard of, right? I mean, they could get together and benefit the buyer and really, really distinguish themselves from their competition as far as sellers are.
I think if there is one, I think the only challenge with that would be, do you think the house is going to appraise? Because to use the 550 to 525, if you cut it to 525 to spur interest, was it worth 550? Is it going to?
Well, then okay, but let's briefly touch on that, because I'm aware, and I'm pretty strong in this belief that everything is going to appraise now, because we're dealing with stuff from 6 and 9 months ago. Yeah, so I don't think there's any appraisal challenges now, because the data is not from the last month. It's from closings at what we described as absurd prices.
Yeah, I mean, it depends how ridiculously priced your property was. I mean,
most were, in that example, 550 to 525. That's less. That's like a 5% difference.
Yeah, so 5% hit. 5%.
So really, I think these cuts. I think that we're in a great period of appraisals. To me, there should be a non-issue for a good year and a half, right? I mean, based on prior data.
I mean, you should. A lot of it depends on the agents and how they've priced these homes, and where the expectations were. if an agent took a listing and told the homeowner that they're going to get them a price just to take the listing, then that could be, it depends on the integrity of the listing.
Right, but that's also harkening back to a prior time. We went through a market just now of how much can you offer over asking. People were getting 110% of their asking price, so that closed. That's all an appraiser cares about.
So you definitely are setting a new market, but you can never tell with these appraisers. But to your point, I think that that's going to that's really creative ways to spur business, to really drive buyers back.
You could stand on the proposition that if if a realtor selects a lender like yourself, you could always have positive price cuts that work for everyone. That's really what is really positive.
I mean, if you did it the way you described it, 550 to 5, if it's a decent decline, it's good. If it's a ridiculous decline, then obviously that calls for further questions. But you're on mute.
Okay.
You're on mute.
Sorry about that. I don't know I was on mute. Yeah, I think that's really, really the point, the purpose, where this is a chance to really, I mean, look, that's an idea that I know has been going on nationally, where you can be quiet, make a positive connection with any agent based on that approach.
Mm-hmm. Correct. Yep, I agree. I mean, it's good. It shows creativity. That's almost like the non-QM side. It's banks getting creative to try to gain some momentum and start to gain some traction. I think it's great. And you're going to see it. You're going to see it more and more. You're going to start seeing, whoa, they did that. You're going to start hearing more of that.
Well, this is another reason where we're in, maybe I don't want to say a crisis, but you're going to see more expert professionals in both the lending and the real estate industry, that they're going to do more and gain more, and the cream will rise again.
It always does.
It does.
It always does. And like I said, it's going to be a little slow for a little while longer until the dust settles, and ultimately it will, because it always does. And it's just set up for what should be a nice spring market, I believe. The question is, how much pain can people?
Well, don't talk about spring market. We're still in August. You're talking about January, February. That's not Russia.
I mean, yeah, that's you do, but you do all your building, and everything is we're a spring and winter business. I don't really think that we're gonna have too much activity. It'll be busier, I think, in the winter than it is now.
Well, this has been, for me and for others, one of the, if not the there's the New Year's week, and then there's this week, because now we're closing. It's Labor Day. It's school. People, I know title companies that I'm associated with, and my own transactions, we have to close. People are, tonight till 7:38, because, you got to show up with your school registration, moving trucks. A friend of mine's a mover. He goes, we're just getting text messages. Is it on? Is it not? Is it on? Is it not? I mean, it's too bad. It's such a fun week, and it's really just a place of so much anxiety, because who knows, if you're not scheduled today, you're not closing this week.
Oh, totally. I mean, if you really think about it, though, these banks are moving, because we're moving files like super quick. It's not we could send the file to underwriting and it's approved in like 2 days. So we're moving them fast. So you might be able to, if you're lucky. Depends on the lender you're with.
But I think, look, your information is always fantastic.
Thanks.
So, definitely we want to share it with the. Sorry, man. There's an old commercial. Right. Go over there, please.
That's right. My kids were running in the back.
Yeah, it's funny. Well, this is the end of the day, so I came out of the office. Yeah. But your information is fantastic, and our best effort, Ava, is to make sure your referral partners see this and empower them. But more importantly than probably all of that is you will offer, and you've done that, provided them a place to promote their business. And I'm proud to have you here. We're going to do big things. I want you to pick up 15, 20 more loans based on this, providing great service and being a fantastic referral partner to your clients and your agents.